know me, I'm Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for our first webinar with Axiom Investors, the new investment team for the Pengana Axiom International Ethical Funds. When we were selecting Axiom to manage our ethical funds, a robust ethical process and ESG integration were obviously critical for Pengana. And I think it speaks volumes about the way Axiom approached these issues, that Unilever, who are widely acknowledged by the investment industry to be leaders in corporate ESG implementation, with some of the best ESG policies in place of any other large business, have actually selected Axiom to manage their own corporate pension plan. Joining us on the call today are Kurt Polk, the Axiom president, who's responsible for all non-investment functions within the Axiom business, and Andrew Jacobson, who's the founder of Axiom, the CIO and the co-portfolio manager of the global equity strategy, which is now implemented in our funds. Also joining us is Russell Pillemer, the Pengana CEO. On the call today, Kurt will provide some background to the business and introduce the strategy. Andrew will explain the investment process and provide some case studies to tie it all together. And Russell will provide some insight about the similarities and differences between the current and previous managers. Kurt, over to you.
Great. Thank you, Adam. And first and foremost, I'd like to thank the Pengana team. We at Axiom are very pleased to combine our approach towards seeking alpha and ESG integration with the Pengana team to manage the Pengana Axiom International Ethical Fund. As Adam said, I'm president of the company and pleased to have our founder and CIO, Andrew Jacobson, who developed our philosophy and process, walk through exactly what we do for our global client base. At Axiom, there are a few key distinguishing characteristics of the firm. First and foremost, we have 55 employees, half of which are dedicated to implementing one driving philosophy and process. It is a dynamic growth philosophy and process focused on investing ahead of the curve. It's a philosophy and a process that has worked in all of our strategies. Every one of our client portfolios are ahead since inception, both gross and net of fees. Our people, highly experienced. We recruited some of the best portfolio managers globally, but it's not just their years of experience. It's their years of experience combined with the stability and continuity and collaboration over years and decades together. And why is that? Why have we been able to put together a team of seasoned portfolio managers implementing a philosophy and process? Well, it all goes back to culture. We are 100% employee owned. We have 23 out of our 55 employees are partners of the firm, so very broadly held. We're completely aligned with our client outcomes. And not only that, we invest alongside of our clients, in essence, eating what we cook. When you put together a proven philosophy and process implemented by a team of experienced professionals who have decades collaborating together, and you combine it within a 100% employee-owned, investor-led firm, we put the odds in our favor of doing a great job for our clients. On the next slide, you'll see some of the key features and benefits, not only of Axiom, but the portfolio for which we're managing for Pengana. As I mentioned, it's one single forward-looking dynamic process. This is a global equity portfolio of 45 to 75 of the most dynamic growing companies globally. High active share, unconstrained. Our entire research platform is dedicated to scouring the globe and finding the best dynamic growth companies, including up to 25% in the emerging markets. We do that looking for these companies that are changing positively for the better, but we do it over the intermediate term, finding sustainable earnings growth companies that can compound over time. And as Adam mentioned, Unilever is just one example of clients of ours that hire us to provide alpha generation from ESG, not just risk mitigation. We have a fully integrated ESG platform that made us the right partner for Pengana to manage this international ethical fund. As you will see, our performance isn't just on the upside. Of course, as a growth manager, our clients expect us to outperform in up markets, but we don't give it all back when the market rotates. In essence, we outperform when the market rises and we protect as the market pulls back. So on the next slide, Dean, who are our clients? As Adam mentioned, Unilever, which is a corporate client, but we do have clients globally. Some of very well-respected firms in the United States, such as John Hancock and Northern Trust, Russell Investments. Of course, Russell has offices in Australia. Sovereign funds such as NPS in Korea, GIC in Singapore, and many others. And you can see the client tenure. Yes, we are a growing firm. A third of our clients have joined us in the last 3 years. That helps us retain and attract outstanding talent. It's also indicative of the performance we've generated for our existing clients. But we're equally as proud of the fact that almost 30% of our clients have been with us for over 10 years. They've been with us for over 10 years because number one, we've done the job. Number two, we've been transparent, proactive partners. And number three is because we've been fiduciaries and hold a culture of compliance that sets the tone for the entire organization. And so maybe with that, I'd like to turn it over to our founder and CIO, Andrew Jacobson, who will walk you through the team, the philosophy, and the process, and how we build this portfolio. Thank you.
Thank you, Kurt, and pleasure to be with everybody. So as Kurt underscored, it's matching the right people with the right process in the right culture and really delivering and partnering with our clients to achieve their objectives. In terms of the team, as you can see here, it's a very seasoned team. Myself and my partner and co-manager, Bradley Amoyles, the lead manager on this strategy, have 30 years plus of experience navigating all different kinds of market environments. We bring that perspective to the implementation of our philosophy. We're supported by an exceptionally seasoned and capable group of portfolio managers, sector analysts, and dedicated portfolio support staff who all work together to make sure that we select the most compelling dynamic growth stocks, get ahead of the curve, buy those stocks when the upside is very attractive and the risks are proportionally moderate, and then monitor those stocks closely throughout the holding period. Just moving forward, in terms of what keeps us aligned in our philosophy, we're very clear and explicit in everything that we do. As Kurt underscored, one thing that really sets Axiom apart is our fundamental stock picking philosophy, and it's very repeatable and very transparent, so our clients understand what we're seeking and how we're implementing this philosophy through time. You can see there are 3 key positive alpha factors that drive our stock selection listed there, and we even are very clear about the relative importance of the different factors. And what this means is that the entire organization can work together, so you get the power of the entire team scouring the globe for the most compelling opportunities. So not only are we finding the interesting, established leading large cap stocks, but we're also able to leverage our colleagues who are focused on the small caps, emerging markets, different pockets of opportunity to really identify these dynamic companies and construct a best ideas portfolio, which is what we express in the Ethical International Fund. So the 3 proven positive alpha factors, as you can see, are first and foremost this idea of something changing in the business for the better. This is so important. Markets are trying to efficiently discount future earnings and cash flows, and it's really some kind of a miscalibration of that future trajectory of growth that creates the meaningful alpha opportunities, the meaningful misvaluations. And by focusing on the leading indicators of future operational and ultimately share price performance, and we'll go into some examples in a moment, by focusing on those operational inflections and accelerations in real time, you can identify those companies before they're obvious to other investors who are waiting for the reported earnings or other kinds of backward-looking financial characteristics to become obvious in the reported financial results, which they can then screen. We take a holistic view when we're taking this fundamental look at businesses. So not only are we looking at the microeconomic, the company-specific drivers, the new products, the market share gains, the distribution initiatives, the changes in management, we're taking into account the macroeconomic context. We have a very disciplined approach to evaluating the macroeconomic headwinds and tailwinds. And we're taking a deep dive on the ESG factors. And again, this is something that our clients really value because we focus not only on the current status of companies' ESG performance, but actually the change in the direction of change in that ESG performance. And that becomes a very significant alpha opportunity because that change in ESG alignment is itself an important driver of returns. We want those returns to be occurring over and on top of an already attractive and sustainable enterprise because we hold these companies for several years. We take a rolling 2 to 3 year time horizon. So every stock we're evaluating over that medium-term horizon, because it's far enough out that companies have a real opportunity to achieve differentiated performance. You're not taking just a short-term quarterly or even monthly view, you're taking a multi-year view, so you're giving companies enough time to really achieve something significant, but it's not so far out. Some folks like to take this 5 and 10 year view, which is always, I think appealing to investors, but the reality is there's so many externalities, there's so many things that can go wrong over that very long-term horizon that it's important to constantly assess and reassess whether or not the investment thesis is on track. And that's something that Axiom really does effectively. And so by taking that medium-term view, making sure the growth is sustainable, continuously reconfirming that, it means that our investors have the benefit of time on their side, that the natural compounding of earnings itself creates tailwinds to performance. And then finally, as growth investors, we understand how important it is to have a sensible valuation underpinning each of our stocks and therefore ultimately the portfolio as a whole, because that provides not only confirmation of the upside potential, because if a company is reasonably valued, it means that those positive changes in sustainable growth aren't implicitly discounted in the share price, even if they're not explicitly reflected in management guidance and investor expectations. Equally important, it provides downside protection. As I mentioned, the team has been investing together for decades. We've seen all different kinds of market environments, and we know that having a sensible valuation underpinning our stocks provides both downside protection and resilience in those stressful moments in markets, and also amplifies the recovery. We combine those 3 alpha factors into this fundamental stock selection process. And I think by combining them together, we really magnify the benefit of each of the individual parts. And I think that that's a really important feature of Axiom. So our mission is to invest in companies that are dynamically growing and changing for the better. So they have the positive change, the sustainability, and the attractive valuation more rapidly than generally expected, and where those positive changes aren't reflected in expectations or valuation. And we translate that into a very structured 4-step process that's represented by these 4 pictures and a couple of really important highlights. First and foremost, as I've already mentioned, we start with the actual data points. So we're not taking a backward-looking view of what the historic growth rate is or what some folks think the future growth rate might be. We look at what's actually happening with the business, and we do a deep dive on the actual current operating fundamentals, leveraging some proprietary tools that I'll get into in a moment, so that we can really objectively, we say empirically, which is to say based on the data, based on the facts, identify opportunities where there's an important improvement in the business. That improvement in the business becomes the basis for doing a deep dive on all of the business drivers, not just a handful of initial data points that catch our attention, in order to really understand holistically the risks and the returns latent in that investment opportunity. Ultimately, that means that the team works together, leveraging a very seasoned group of global sector analysts and seasoned group of portfolio managers to arrive at a consistent risk and return score for every security before it's proposed to the portfolios. And that risk and return score, and we'll talk about it more in just a moment, becomes the basis for security recommendation and ultimately the potential for its inclusion in the Ethical International Fund. importantly, because we define up front what those key metrics are, what that key information is that confirms the upside potential and the risk and return score, it means that we can, on an ongoing basis, reconfirm and reevaluate the integrity of the investment thesis on an ongoing basis. And so that feedback loop that you see, that relates to the work we do as a team to every day rank literally hundreds and hundreds of data points relative to each of our portfolio holdings, the sectors, the industries, the countries in which they compete and exist, in order to continuously reconfirm those risk and return scores, potentially upgrade or downgrade stocks, adjust position sizes proactively, and that also becomes an important feedback loop in our new ideas process, because as you monitor these companies, you inevitably come across interesting new opportunities as well. One of the critical tools that we use to sustain that effort through time, and we've had it since our inception, it goes back now over 20 years, is our proprietary internal research database, which we call Axware. There are over 3,500 companies in our database now, over 1 million individual data points. We add over 100,000 data points a year, both microeconomic and macroeconomic, including ESG data points. We score all of that data fundamentally, so it's all of the data is entered by one of the nearly 30 investment professionals that collaborate to sustain this effort. And it's fundamentally scored positive, negative, or neutral as it relates to the investment thesis, color-coded red to green so we can easily visualize improvements and deteriorations, and then related back to that risk and return score to make sure that each of those incremental data points support the investment thesis, so that not only can we get into these companies ahead of the curve, but we have a clear and highly structured process for reducing or exiting stocks if there's an evolving or emerging problem with the investment. So that's a little bit about our philosophy and process, with I think a lot of proprietary and differentiating tools that I think really ensure that we achieve a consistent implementation. I've talked about this already, so I think it's worth just spending a few moments on. This is this risk and return score that I've mentioned that we sustain for all of the investments in the portfolios. A lot of the folks who know us well, Pengana spent a great deal of time with us, really think of this risk and return rating as quite characteristic of Axiom. Our investors appreciate the fact that they can always understand how we're thinking about the risk and return in different holdings. As you can see, the risk score is a letter grade A through E, and we have 4 consistent categories of risk that we evaluate with 20 consistent elements, each of which is predefined to ensure a consistency of implementation through time and across strategies. So we think about enterprise risks, things like liquidity and capitalization and global market position. We think about financial risks that relate not only to the balance sheet and the income statement, but the cash flows and the cash conversion and the credit characteristics and the financing characteristics. We do a deep dive on all of the different ESG elements. So that's the third category of risk. If there are any tail risks or opportunities in their approach to governance, social or environmental matters. And then finally, we take a deep dive on the statistical risks, the characteristics of the enterprise, considerations like beta, historic drawdowns, volatility of return, shareholder structure, and we combine all of those different elements into a consistent risk score. And then on the other axis, as I've already talked about, we're looking for the intersection in our upside score, our dynamism score, which we rate 0 to 3. We look for the combination of really compelling positive changes, which indicate that the company is going to meaningfully outperform over the 2 to 3 year time horizon, and we roll that forward every quarter, so it's always looking out 2 to 3 years. So first and foremost, positive changes in the operating fundamentals, and to get the highest score, the 3 score, the company would have to be tracking 20% or more ahead of management guidance and consensus expectations. So in that critical positive change characteristic, we look for similarly high levels of sustainability, high organic growth, high cash generation, high returns on equity, and so on. And then finally, a compelling and attractive valuation, both in absolute and relative terms. And that's to get the highest score, and then correspondingly more moderate, but still attractive scores for the 2 and the 1 category. Ultimately, we want to populate the portfolio in the target blue zone with the largest position sizes as close as possible to those A-rated least risky stocks. So the least risky stocks are scored A, but that have the most dynamism, the most positive change sustainability at the best price. Those are the big position sizes. And then as you move concentrically away from that ideal box, position sizes are moderated, either because there are these niche businesses, the C's and D's. Those are attractive, smaller companies that may be number one at what they do. We'll talk about an example, but they're inherently a little more susceptible to competitive or economic cross currents because they're just in one area of the global economy. So we moderate the position size accordingly. Or some of these larger companies that aren't quite as dynamic because they're a little more mature. It means that we can have a really interesting mix of large and small companies in the portfolios, and we can combine them in a very thoughtful and consistent manner, so that not only do you get the benefit of owning some of these larger dominant companies when they're particularly dynamic and changing for the better, and there's some examples in our portfolios, we'll talk about one, but more than half of the portfolio is actually in those interesting emerging niche businesses that you really probably wouldn't find in many other portfolios, but offer not only diversification, but a lot of differentiated alpha as well. So that's how we approach that portfolio construction. Maybe just moving forward. Critically, we've collaborated with Pengana to make sure that we implement consistent, ethical screens in the portfolios. And so we have pre-trade analytics and actually, integrated into the early analysis of our stocks, a whole series of very specific criteria related to the different categories that you see listed here. One thing that I think is very differentiating about Axiom is our approach to active ownership. We have over 2,500 currently ESG points of contact with our portfolio holdings across our different strategies. We talk to every single company in the portfolios about their approach to ESG, and we focus and target the most impactful potential areas of improvement. The portfolios have currently a more than 2-to-1. It's nearly 3-to-1 upgrade to downgrade ratio from the third-party raters of ESG alignment. So folks like MSCI and Sustainalytics, we follow MSCI, are actually continuously upgrading their evaluation of the ESG performance of our companies because of the kinds of issues that we focus on, the active engagement with companies to improve their performance. And it's important to note that that improvement in ESG alignment has actually been associated with as much as 100 basis points of positive alpha generation. So the benefit from actively engaging is actually quite compelling and is actually larger than the benefit that you get from simply owning good companies and avoiding bad ones. And I'm sure we'll talk about that more. And then transparency. We are committed to being great partners, transparent partners with our clients. And so we provide all kinds of bespoke and customized reporting to really partner with our investors to achieve their ESG objectives. Maybe just moving forward. We did want to include a few examples because it always feels a bit dry without an example to bring things to life. So one example that I think is kind of representative of some of the differentiated sorts of stocks that you find in Axiom's portfolios is Trex, which again, it may not be a household brand name that fits into that niche category, but remember, 65% of our portfolio. So people always look at the top of your portfolio, the large cap stocks that show up at the top, and those are important, and it's important to get those stocks right. And we certainly have a number that you'll notice that are impactful stocks. But over half of our portfolio, in fact, nearly 2/3 of our portfolio are these niche and differentiated companies. And Trex is, I think, a typical example. And I think it's one of the reasons that not only do we provide an interesting expression of ESG and of helping to make the world a better place, but also differentiated alpha. So Trex is really as you can see, the world's largest manufacturer. So they're number one, but they're number one in a niche. So as we'll talk about in our rating system, that makes them a niche business. So they're the number one maker of composite decking. So many people are now aware. We've owned the stock now for about a year, but so everybody's now aware that lumber is in very tight supply, and that there's a global shortage of lumber. and that there's this phenomenon that's going on as a result of COVID, particularly in the US, the UK, and a number of other countries, of people really focusing on improving and upgrading where they live because they're spending so much more time at home. And it turns out that lumber is actually, as you can imagine, not necessarily the best product to use for exterior applications because it deteriorates, it goes without saying, and you have to constantly maintain wood. And so a better way to kind of construct some of these exterior outdoor spaces is to use what's called composite decking, which is essentially made from recycled plastic. So in addition to providing a better product, Trex is also an incredible part of solving a terrible environmental problem, which is what to do with waste plastic. They're the #1 recycler of waste plastic in North America, and they make it into this incredibly functional decking product that, because it doesn't need to be constantly maintained, has a total cost of ownership, which is considerably lower than wood. So their traditional product, the one that historically fueled the company, was a very high-end product. It cost about more than 10 times as much as wood, but because you didn't need to paint it every year, it paid for itself in 5 to 7 years, depending on where exactly you lived in the country and the weather and so on. One of the things that really attracted us to Trex, and one of the things that was interesting to us, is they sought to launch a lower end product that could address the mass market, beginning about 2 years ago, that had a lower purchase price, about half the cost of their high end product, and it made the addressable market much larger. So just briefly, I won't dwell on it too much, but it's important to understand what the company does. Currently, only about 20% of the market is this composite decking, and it's partly because it's so expensive to buy up front. So the company launched this new product to address that kind of mass market. We owned this company actually in our small cap funds, and we'd owned it since it was below a $5 billion company. And one of the things that really interested us in the global portfolios last year is Trex was going through a little bit of teething problems as they launched this new product. It's actually hard to make. There are a lot of issues with just product quality, and so the stock was going through a little bit of a soft patch as they were struggling to get this new product introduced. But we could see the market potential, and they are the market leader. They're #1 at what they do. They have a 50% market share. It's a very highly regarded management team, a very deep management team. And so we viewed the issues they were having scaling the new product as a potential opportunity to expand the use of this company. The last thing I'll say before I dive into it just a tiny bit is it also shows the power of Axiom's unified approach to investing, because it means that a company that's covered by our small cap US team can easily be integrated into our global framework because they're rating and ranking all of the information in exactly the same way, which brings me to what you're looking at here on page 13 on the screen, which is a snapshot from those Axware entries. So I mentioned Axware, the database, 3,500 plus companies, proprietary, million plus data points, over 100,000 a year, everyone color coded, all shared. So I have this screen. This is a screenshot of a screen that I keep on my desktop open all day. Everybody at Axiom does. And we have like a running flow of all of the fundamental data points, each one of which is entered by one of the fundamental analysts. So if you look closely at what's on your screen, see that a lot of different people are collaborating. So it's a shared tool. If you look under that user column, you'll see different initials. Those are different members of our investment team. So we're all really collaborating in a unified way. You can see there's a score that's color-coded red to green, so that's good to bad. That's a fundamental analytic score that's discussed at our morning meeting, so you have to defend that score. And then there's detail on why that score is merited. And to get a green score, you have to be tracking essentially 10% ahead of expectations over a 12 to 24-month time horizon. And then there are different categories of information. So it's a holistic, it's a robust approach, everything from conversations with management to news flow in the industry to bespoke kind of contacts within the industry value chain. And all of those things were indicating that the company was beginning to turn around this new product cycle that could really drive accelerated growth for the business. We have a similar kind of monitoring process for what's happening in the macroeconomic data in 100 countries around the world, including obviously the US. We're scoring all of the growth, inflation, and national balance sheet indicators. So we were seeing very early on in COVID the acceleration in consumer spend on home goods. So we could see macroeconomic tailwinds, we could see microeconomic tailwinds. We have a robust kind of perspective on the enterprise, and all of these things supported the critical point, which you see in that operational acceleration list there, the company was tracking for more than twice the growth that analysts had embedded in their medium-term forecasts. That's what gets us excited. A high return, highly cash generative market leader showing an acceleration in their business with a sustainable tailwind for a period of years as they roll out this new product. Maybe just moving forward to a couple other points. So that's idea generation, how we leverage the whole team to achieve that with some pretty differentiated tools. Obviously, having said all that, we need to take a deep dive on all of the different drivers. I mentioned our ratings framework, and I mentioned that we have a very structured process. So you can see on the right-hand side of this page, on that return rating, that was the 0 to 3 rating, we go through in a detailed way 20 different factors. Every single time we talk about a stock, we go through 20 different factors, about a third of them related to positive change, a third related to sustainability, and then a handful related to valuation. And we score each of those elements based on consistent set of data points, 0 to 3, to ultimately arrive at a return rating for that stock. We have a similarly structured approach to the risk rating. I mentioned there are 4 categories of risk. Again, you can see those categories: the enterprise risks, the financial risks, the ESG risks, and the statistical characteristics. Again, a consistent set of 20 factors that we're evaluating in order to arrive at that score, ultimately to conclude that this was an attractive risk and return. As we'll see in a moment, a C2 rated stock, which is a good niche business with a lot of upside drivers and reasonable risks relative to those upside drivers, and specifically a very attractive gap between what people were forecasting and what the company was achieving. So maybe just moving forward, a holistic approach to risk and return with regard to the ESG, because this is an ethical fund, and we get a lot of benefits, I think, from the ESG component, not only of the risk analysis but the return potential. And as you can see here, this is even though it's a smaller business, at the time we were advancing it into the global strategies, it was about a $7 billion market cap. Now it's more like a $12 billion market cap. So it's obviously done very well. But looking at each of the different elements of ESG, their approach to governance, capital management, the reputation and depth of management, the incentive alignment, the social, the environmental risks. We even look at the country risks. So, some of our businesses are competing in countries that have, say, some challenging dimensions to them. And so we take a deep dive and really make sure that we're not taking inappropriate ESG risks. In this case, I think actually it was an attractive stock with real tailwinds from particularly recycling and this issue of how to recycle plastic. Just moving forward. Ultimately, what that means is, this company really fit within our target zone, our risk and return blue zone, where we really want to populate the portfolios. A niche business, so typically that's about a 2 to 3% position. Ultimately, we build them up gradually over time, and again, on an ongoing basis. Just to kind of conclude the example, if you just roll forward one more slide. Every day, literally every day, I'll just say that it just happens. This wasn't planned, but it just happens that Trex reported earnings last night, so we saw their earnings overnight, and they once again put up a near 10% earnings surprise. They actually guided earnings up going forward. But really, every day we're ranking information on all of our holdings, and Trex is just an example. So we can continuously look in Axware. We can see all of the different data points that relate to the investment thesis. What's happening with this new capacity that they're bringing on, what's happening with consumer demand, what's happening with the competing products, the price of lumber, their competitors' composite decking, what's happening with contract signings with the retail distribution channels. And so we can continuously reconfirm that the investment thesis is on track. And as you can see, if you look very closely, we also, over the holding period, typically experience investors really appreciating the ESG components of the companies in which we're invested. So in the middle of this sort of list of monitoring items here, and it's pretty recent, you can see that MSCI, one of the leading third-party rating ESG rating agencies, actually raised their rating on Trex to an A rating stock, an A-rated stock, reflecting the importance of what Trex is doing to improve the situation with plastic waste. So just moving forward. So that's an example of a niche business. You know, I think it's important also just to address, you know, how we approach some of these more well-known stocks, you know, and you know, there can always be a question of, you know, how do you achieve differentiated performance with, you know, the better known or more established names. It's worth noting that Microsoft has been a top holding in the portfolios, typically a top 5 holding in the portfolios, really now for nearly 6 years. The company has compounded at about 40% over that holdings period, which is more than twice the benchmark rate of return. So really important to to get stocks like Microsoft right. And if we just move forward, no details here, but you know, our team is, we've got, you know, 2 very seasoned, dedicated technology analysts who've really been outstanding at getting ahead of the curve and identifying these transitions from license models to recurring revenue cloud subscription models. And that's what's gone on with the Microsoft Productivity Suite. On top of that, you know, we've been very effective at appreciating this transition in the basic organization of how people handle their you know, data infrastructure and the movement to cloud and hybrid cloud environments. And Microsoft has literally been outstandingly well positioned for both of those, you know, we'll call them, you know, huge, you know, secular trends within, you know, within technology. And so that combination of 2 dramatic drivers for Microsoft, both of which have been structurally under forecast by the analysts in a durable and sustainable way, has continued to fuel significant outperformance by Microsoft. And so both components of that thesis, both the movement to Office 365, as well as the you know, market share gains and dynamic growth of Azure, their, you know, cloud and hybrid cloud you know, solution infrastructure as a service product, have been persistent sources of positive surprise for Microsoft throughout the holding period, and we continue to view it as an important component of our portfolio construction. So, you know, with that, just a few words on performance. You know, you can see that we've been able to compound out strong returns through different kinds of market environments. You know, even you know, this year to date, you know, where it's been a tougher environment for growth, we're certainly holding our own. And so that focus on achieving consistent outcomes on behalf of our clients by having differentiated portfolio holdings with a whole variety of different alpha drivers has been, I think, really critical to how we've you know, delivered through different kinds of market environments. Just moving forward, you know, one critical component to that is not only have we had an attractive excess return, but we've done it with a high batting average. So if you look at our quarterly performance, you know, whether it's ahead or behind the benchmark, you know, 64% is an outstanding batting average with, you know, consistent outperformance through different kinds of market environments. Importantly, you know, we've controlled risk. So many different measures of risk. We think about risk through a lot of different lenses, but certainly those include, you know, conventional measures like standard deviation and upside downside capture. You know, again, high upside capture, 150%, but really inline downside capture, just in line with the market. So, you know, holding our own during market downturns, but really capturing a lot of the upside potential, which is what I think people seek in a growth manager. Reasonable tracking error, resulting in a really attractive, I think, information ratio and Sharpe ratio, and particularly Sortino ratio, which gives you credit for the upside capture relative to the downside capture. That ratings grid is something we use internally. It's not just something we talk about, you know, with our clients. And so this is a snapshot of the, you know, the portfolio as of the end of the most recent quarter, you know, with a range of different holdings, certainly a handful of A2s and B2s, the larger cap companies that you'll have heard of, but many of these niche businesses like Trex and others in that niche category. And then even, you know, including some companies that are leveraged for reopening, where the current operating performance is maybe, you know, a little bit challenged because, you know, reopening is still kind of a choppy situation, but which have significant opportunity to really outperform over the next 2 to 3 years where we're starting smaller positions with the idea that we'll build them over time. So just a little word on portfolio construction. These are some of the key holdings in the portfolios, obviously some that you'll know well and some others that you may be less familiar with. Always trying to find that balance between making sure to benefit from, key large caps that are really, at the heart of some of these important secular changes in society and in the industrial landscape, but also finding interesting niche businesses to diversify alpha and diversify risk. In terms of sector exposures, again, well diversified by sector, by region. Clearly North America, an important opportunity set, but finding businesses around the world. And then this is just a snapshot of recent portfolio characteristics to give you a sense for where we stand at the moment, with 50 stocks, liquid, well-capitalized stocks, little debt on the balance sheets, high growth rates, and benefiting from significant positive changes in their operating fundamentals. There's just the structure of the fund. So we have broad guidelines in order to be flexible and really be nimble and include interesting companies across the range of opportunities. Importantly, you can see the lower bound is set at 0. So we don't have to own something if we don't think it's attractive. We don't have to own, just to pick on a sector, a traditional fossil fuel company if we think that there are secular headwinds and, so the minimum is always 0, but we're able to double weight areas where we see significant opportunity.
Thanks, Andrew. Good morning, everyone. So we have received a number of inquiries from investors about how the Axiom strategy has performed relative to the previous strategy that the fund had employed over the last 5 years. The slide on the screen is separated into 2 parts. On the left-hand side is the stated gross performance of the Axiom strategy relative to its benchmark. And on the right-hand side is the fund's previous strategy relative to its benchmark as well. The Axiom strategy is expressed in USD and our previous strategy in Aussie dollars. So the charts are not directly comparable in terms of gross performance. However, in a broad sense, in our view, what can be compared is what is termed alpha, which is the outperformance of the strategy relative to the benchmark. Importantly for us, both strategies over all time periods outperformed their respective benchmarks, which was a good accomplishment. The outperformance of the Axiom strategy was, however, significantly higher over all periods, including the generation of an impressive 4.4% per annum alpha over the 5-year period compared to 1.5% for our previous strategy. As you know, we always state that past performance is not a reliable indicator of future performance and so should not be used for these purposes. Nevertheless, we have provided this analysis as we know that it is something that is of interest to you as investors. One of the caveats that should be noted is that the Axiom returns do not incorporate the ethical screens that Pengana will overlay onto the strategy. However, considering the strong ESG requirements contained within the Axiom strategy, we do not think that the results would have been materially different. Moving to the next page. This page looks at the compositions of the 2 portfolios. It shows the differences in portfolio construction of the Axiom strategy and the old strategy we employed. As you can see, there are similarities as well as some quite significant differentials. However, in our view, these differences should not be overstated, as this is only one snapshot in time, whereas in actuality, these exposures have changed significantly over time. This is because both strategies have very flexible mandates that enable them to alter exposures under different conditions, which is certainly something that we at Pengana look for across all our offerings. I'm going to now hand back to Adam Myers for the Q&A segment of the session. Adam, over to you.
Thank you, Russell, and thanks to everybody else as well. That was a very comprehensive update. We do have a number of questions ready that have come through, and if you have others, I didn't mention, but there is a Q&A box at the bottom. I normally mention that in my intro, that there is a Q&A box at the bottom, so please enter your questions there if you have some. Russ, the first question is for you. Please, can you talk through Pengana's process and how Axiom was actually selected?
Sure, thanks, Adam. So we had quite a unique opportunity at Pengana with regards to the strategy, in that we were looking for a new manager, and we had the world to choose from. So we certainly did not limit ourselves just to the Australian marketplace. There would be no reason to do that, seeing that Australia is a relatively small part of the world, and this is a global market that we're looking to try and tap. What we did is we employed one of the large global asset consultants to actually provide us with our shortlist. So we whittled down the number of names. We whittled down to a half a dozen prospective candidates for the position. And the way we did this was providing very definitive guidelines to the consultants as to what we were looking for. So we were looking for a highly credible manager with a very strong track record, very strong team with excellent ESG and ethical credentials, and a team that we could work with on a cultural basis, etc. So we came down to a shortlist. From the shortlist, I must say that Axiom was a standout performer for the strategy. And we're very pleased to be able to have entered into a joint venture with them. I actually have had a long-term relationship with Axiom for many years now, and Adam as well. So the two organizations have known each other. We've never actually cemented a relationship to date. So it was very pleasing for us to see that even though we knew Axiom for a long period of time, they were very highly rated by the consultants and came up in the consultant search as well. So it was an excellent outcome for us.
Great. Thank you, Russ. Next question, Kurt, and I'll address this one to you. You obviously are a very large organization, around 25 billion in Aussie terms. Is Australia really going to be a priority for you?
Yeah, absolutely. First and foremost, just, I think the relationship with Pengana is a perfect example where, I've met with, of course, you and Russ in your offices. I've had other colleagues and partners visit the Australian market, and, we're rated positively by the global consultant space. And so, we view the ability to add value in a global growth portfolio as something that is desired by the Australian market. And as president of the company, I can tell you that we are committed to the Australian market.
Great, thank you. Andrew, I think probably this one for you. Most allocators will select a fund because it blends well or complements with the other investments in the portfolio. What kind of investments do your US investors typically blend your strategy with? And as a second part of that question, what factors would typically just sort of drive the decision of your investors to make an investment in your fund?
Sure. There are obviously a number of different frameworks that people think in terms of, but the ones that we encounter most often are thinking about Axiom as a high alpha complement to an existing maybe passive allocation where they're really seeking differentiated stock selection. I think the Trex example is just one example of not only finding some of these really high potential larger companies, but also layering in a significant position in interesting emerging sustainable growth companies. And so that desire to add some alpha to portfolio allocations is important. Sometimes it means complementing a value manager. Sometimes it means complementing a kind of a passive allocation, but always with the idea that we can provide a differentiated source of alpha. The other thing we find is that our approach to ESG is something that our clients really value. Univest was mentioned. Univest, like Pengana, did a global search. They really evaluated all of the different alternatives, leveraging the consultants just as you folks did. And one of the elements, in addition to the alpha, that they really valued was the active engagement and the commitment to really working with companies to not only invest in businesses that are good, but to drive positive change. And so this alpha potential from positive change, but also the social impact. So I think those two things really are critical differentiators within our client base.
Great, thank you. Andrew, you mentioned a high batting average. Please, can you just explain that term? We have an investor who's not familiar with it.
Sure. Well, that was a statistical measure. So there are different measures. That particular one was if you take the long history of the fund and you just look at the number of quarters where we outperformed versus the quarters where we underperformed. If you're an active manager and you have over 60% and our batting average is over 60%, that's a really outstanding level of consistency, particularly if you're a high active share. So we're true stock pickers. We include real stock selection, but because of the commitment to risk control, because of the commitment to what we call diversified sources of alpha, we've been able to perform in all different kinds of market environments. And so whether you measure it by quarters where we outperform relative to quarters where we underperform, that was the batting average statistic. You measure it by upside versus downside capture, that's the 150% upside, but the in line with market downside. You measure it in terms of percentage of rolling 3-year period. Many investors take a 3-year view because I think that's a more sensible kind of perspective to think in terms of rolling returns. With a very high percentage, well over 60%. Rolling 3-year time periods where we're ahead of benchmark. So many different kinds of measures of consistency of outcome. But the one I was specifically talking about was quarters of outperformance versus quarters of underperformance.
Great. How has the portfolio evolved over time? Andrew, this is probably another one for you. What would some of the larger holdings have been 5 and 10 years ago that wouldn't be included in the portfolio today? And what do those differences typically entail?
Sure. Well, I think one thing that's important to mention is, if you look at portfolio, position level, name turnover, we do have a 3 to 4 year holding period, and so you should expect that multi-year holdings. Going back a couple of years, we certainly had a bigger position in emerging markets. So if you look at the emerging market position in the portfolios currently, it's quite a bit lower. It's actually low single digits. We've been cautious. I think emerging markets are attractively valued, but we correctly reduced our exposure in countries like Brazil, where we had some exposure to the local financial institutions. In India, in China, we had more exposure. We recognized that there was a period of disruption that was unfolding. Obviously, the trade wars between the US and China were a part of that. Some of the slowdowns in the commodity markets, which have only recently really reversed, created headwinds for several of those emerging markets. And so we moved some of the capital that had been in emerging markets into some of these interesting emerging companies in developed markets, including related to consumer opportunities, high tech, the software companies, e-commerce. We have been, selectively re-engaging with emerging market opportunities. You'll see one of our holdings is this company C. You'll notice that one of our companies is this company C, which is a Singapore company, but their business is really driving e-commerce and online gaming in Southeast Asia and more recently in Latin America. So we're always looking for whether or not it's appropriate to reallocate capital back in that direction. But that was an important source of funds for us relative to a few years ago. And that I think has actually proven to be, a good risk control, but also, positive for returns as well.
Great, thank you. Next question, Tencent. A lot of regulatory risk, a lot of noise around the share at the moment. Performance hasn't been great this year either. Can you talk through your thinking on that stock?
Sure, sure. You know, again, Tencent's an example of one of the companies that we decided to retain even when we reduced our exposure to emerging markets. So for example, we had some exposure in Alibaba, but we exited entirely. That was a case where specifically we downgraded the stock for ESG reasons. We downgraded it because of governance related to Jack Ma before he had the issues with the Chinese government, as well as because of concerns about anti-competitive practices, which have ultimately proven to be a problem for the company. And so that was an example of a company that we avoided problems by being ahead of the curve and recognizing some of the ESG challenges. You know, when we reduced our exposure to China, we did decide to retain a kind of a more moderate, you know, reduced core position in Tencent. As everybody's probably aware, Tencent has the absolutely dominant, you know, social networking platform in China. They have an important emerging business in you know, digital payments, in online gaming. They're dominant and they're expanding globally. And then one thing that we've been very excited about with respect to Tencent and has continued to be in evidence is they've made hundreds of billions of dollars of early stage, ahead of the curve investments in new emerging technology platforms, both in China and around the world. And they continue to crystallize some of those investments, both in, you know, social media as well as in e-commerce. And so that underappreciated, unrecognized asset has kept us very interested in the undervaluation and structural growth in Tencent. And finally, I'd say of all the kind of companies that have had to navigate the current regulatory concerns, you know, Tencent is faring much better than the other companies. And so we do feel that they'll weather this kind of period of you know, regulatory scrutiny and emerge kind of with a reinforced competitive position and with some very significantly undervalued you know, holdings.
Great, thank you. We are almost out of time, but I want to ask one question, which there have been a number of questions on this theme, just around the transition from the previous portfolio holdings to the Axiom portfolio holdings. Now, I know that that transition is almost complete. There is only one holding that still does have to be transitioned. But please can you tell us a little bit about how you approach that to minimize trading costs, to minimize market impact, and to ensure that people retain their invested position through the market movements?
Sure. You know, we have an extremely seasoned group of dedicated traders. So we have, as part of our team, 24-hour live coverage of markets. We are integrated with our fiduciary and compliance team. And so each of the transitions has actually been carefully managed in a collaboration between our trading team, our investment team, and our compliance team to ensure that we did not sacrifice you know, market participation or have you know, inappropriate kind of frictional costs. And so each of the trades has actually been mapped out in collaboration between those teams.
Great, thank you. We didn't get to all the questions, unfortunately. We will respond to everybody whose questions haven't been addressed in this Q&A session separately, but we are out of time. Thank you very much for a very comprehensive update. Thanks to all the participants, and thanks for everybody else for joining us. This is obviously only the first introduction to Axiom, but we hope we have provided you with some very solid reasons to feel excited about the way these investments will be managed going forward. We also hope to have research house ratings in place shortly. I was very encouraged looking at the attendees today to see a number of researchers who dialed in. So thank you to all of you for dialing in as well. If you have any other questions, please get in touch. And thanks very much for joining us.